Okay, folks, welcome back. All right, so this is the price action model number 2. This is going to be specifically dealing with short-term trading. Now, the model I'm building it on is weekly range expansions. Okay, for the short-term weekly range price action model number 2. This is going to be more or less how we break down the overall price action models. The point of these are not so much to overcomplicate it and to reteach the mentorship, but kind of like pull certain segments of the content in logical locations for the premise behind each component. Here, as you can see, I've given us a model of a stage, setup, and a pattern. And specifically, on a larger perspective, the stage is going to be our weekly direction. That means we have to have a directional bias for the weekly candle. Okay, and the setup is going to be our range expansion, and our pattern is going to be based on the PD array matrix and looking for opposing PD arrays. Okay, so we're going to be looking at the concept of range expansion, and these candles are crude depictions of a weekly candle. And on the left hand side, we're seeing a crude depiction of a weekly up close, and the open is going to be specifically referred to in this model. And you can see here for the bullish weeks, what we're going to use as a context for the draw, or why we believe that the weekly candle should go up, is it's going to be targeting a buy stop liquidity pool, or an old high, or a fair value gap above where the market opens for the week. Conversely, when we're bearish, we're going to be using just 3 PD arrays. Again, the fair value gap, old low, sell stop liquidity pool. Really simple. Okay, so what do I mean by this? What's the context of what I'm showing you here? Obviously, we went through a lot for the mentorship, and I'm limiting our focus to this model to only looking for fair value gaps, old highs and lows, and the liquidity pools resting beyond the old high or low. So our understanding is we want to see when the market is relatively bullish, we'll be opting to use the model for our stage, if you will, on the left hand side here with the bullish up close expected. When we're bearish, we're going to be using the model shown to the right when we're expecting a down close for the week. It can be one of the 3 PD arrays. The fair value gap, in other words, an area where price needs to be rebalanced on the weekly chart, an old high or low, where it may retest or reach up into a order block or below into a bearish order block. Now the order block itself is not being delineated here or mentioned as the PD array, but you can substitute the old low with order block. And then obviously the liquidity pool that will be resting just beyond a short-term old high or low. Alright, so we're going to be looking at a bullish example here. And you can see here on the right hand side, this is a weekly chart, so you know it's the weekly chart of the dollar CAD. And I'm using this example because it's something I traded. You guys seen examples of it. You've seen executions as well. So everything here is based on something I actually did. So right away we can see that there was equal highs in the dollar CAD pair, and then right above it we have an old down close right before the move up. So only buy side delivery has been offered at that blue line. So there's an old reference point for institutional order flow and a fair value gap that resides, and that is seen here. Okay, so only sell side delivery has been offered from this point on down. Using this area here, the open on this candle, trading higher. So I'm framing the fact that we only went down here. This candle went up to this price point, left this inefficiency here. So our fair value gap is the draw. That's what's causing our bullishness or view for the dollar CAD in this example, why we expect it to go higher. And also, we have a liquidity pool here as well with an old high. Okay, so we have old high, liquidity pool, fair value gap. Okay, so let's take a look at what transpires as a result. Okay, price trades up into and fills the fair value gap right there. Okay, and again, this is the setup. We're looking for the weekly candle to do this very thing here. Now you can see price does in fact open on this week here. And again, these are weekly candles. You open, it trades down a little bit and goes higher. It opens, trades down a little bit and goes higher. This week here, it opens, does move a little bit, but eventually you would have been stopped out on this particular week. And then we have the really big bullish candle that takes us right up into a rebalancing of the fair value gap right here. Okay. Okay, so let's take a look at what is the opening price for our price action model for this. Now, obviously, we can use the Sunday's opening price, or we can use Monday's opening price, okay, at midnight New York time, or we can use, in this model, we're going to be using the opening price on Tuesday. Now, why am I going to be using Tuesday? Is because Tuesday typically will create the higher low of the week, but we do not require having that level of precision if we're going to be short-term trading, because the logic I want to build into this model is you don't want to be sitting in front of the charts all the time, but you do want to capitalize with some measure of intraday price action. And the way we're going to be using that is we're going to use the opening price on Tuesday at 400, and we're going to use that time so that way we don't ever have to worry about going back and forth with daylight savings time. Okay, so if you use that hour, you don't have to toggle anything. Just keep it like that all year round. Just leave it. Okay, and the idea is that opening price, which is being delineated here on this particular week, this is Tuesday's trading, that opening price, when we're bullish, we want to be buying at that price or below it. Now, if you're going to be rather lazy and not be up during the London session for entry, what we'll be doing is we'll be buying at that price and then using a 50 pip stop. Really simple. So all you have to do is find out what time it is in that 400 hour, and if it happens to be on line with 12 o'clock midnight in New York time, or if it's a little bit earlier or whatever. Long and short is you don't have to worry about that measure of precision because we're short-term trading and we're using it as a filter. Okay, so when we're bullish, we're going to be buying below this price level. Ideally, we want to see what would be residing below this level in the form of a discount array. We could look for a short-term swing low, as we see here. Short-term little swing low here. Price doesn't go below that, so you could put a limit order at that low, or that low plus 3 pips, or 5 pips rather, and then at that price point, then use a pip stop below it, okay, as your protective stop loss. And we'll be looking for an expansion on the week, and because we don't know always if it's going to be a tiger by the tail that we've caught, we want to have some factor of time involved. So while I'm giving you the price element here and certain measure of time because of the Tuesday, we want to be holding on to the moves until Thursday New York Open. Okay, so between Tuesday and Thursday, that's the bulk of the weekly range, and we want to be at least minimum hold until Thursday's New York Open. Okay, so what is the pattern? At the 400 candle, that opening price, we want to be buying under that on Tuesday or Wednesday. That means if we don't get an opportunity to trade below it on Tuesday, then we wait until Wednesday. Wednesday may, in fact, not give us an entry as well, but if it does trade below it, we will be looking for an opportunity to go long. We will use a 50 pip protective stop loss on our demo account. And again, we're going to be holding for New York open or stop out. And again, the idea starts on Tuesday. We do not trade on Monday in this model. The ideal draw is again on the weekly chart over here for why we believe the price should go higher. Again, this would be delineating an intraday perspective on Tuesday. When we're bearish, again, this is a weekly candle here, delineation with fair value gap, old low, and sell stop liquidity pool as our discount arrays for the draw on the weekly candle. This opening price in here, what we're utilizing is the idea of power 3 on the weekly chart, and we're going to be looking for, now this opening is not necessarily what's going to be derived on our weekly chart here. This may in fact be something down here. In other words, this opening price here may be a little bit lower in the weekly candle, which is fine. We don't necessarily need it to be at the very, very high. Again, with this model, I'm building the idea that we're using the highest probable day of the week, which is Tuesday and or Wednesday. And the idea is we want to know where the weekly chart is most likely reaching for. Think about it. Instead of trying to day trade and we're trying to figure out multiple candles intraday to see where it's going to go, we're only looking at a weekly candle. It's either going to go higher or lower, or it's going to sit sideways. If we are studying price on the weekly chart and we can see that these levels down here would be obvious candles to be filled, then we're waiting for Monday's trading to give us an insight whether or not this may or may not come to fruition. Ideal scenario would be this whole move up and then we traded below it for Monday. Then if we see a similar scenario where we open at the 400 candle on Tuesday and then rally above it, we could be a seller above that price level, use a 50 pip stop loss, and just aim for Thursday's New York open. That's our first objective. That doesn't mean collapse the trade entirely. It just means that that's our first minimum objective for time and price to meet. So we're going to try to get the bulk or the lion's portion of the weekly range between Tuesday and Thursday. Again, we're going to hold for New York open on Thursday or stopped out. Okay, so what's the logic behind this entire model? The weekly range, when bullish, will likely see a strong up close on Tuesdays. We do not need to capture the Monday low of the week if it forms at all on this model. Now, when bearish, we do not require the Monday high of the week either, should it form as well. We are seeking the range within or inside the weekly range between Tuesday 400 candle opening price and Thursday's New York open as a minimum objective for time and price theory. Now, your homework is to go through the charts and find scenarios like this where it allows us an opportunity to capture some expansion either when bullish or bearish using the weekly candle, because we're short-term trading, so we're going to be focusing primarily trading inside the weekly range. And our time frames for this model are obviously the weekly candle or weekly chart, the daily, and we're going to reduce it down to the 1 hour. Now, for timing purposes, you can use a 15-minute time frame instead of an hourly chart. That's going to be it for this one. I will be giving you your price action model number 3 next, and that's going to be a swing trading model. And until then, I wish you good luck and good trading.